Thanks everyone for joining today's Giraffe Connect episode on this evening. So today's Giraffe Connect, we'll kind of a little bit talk about the alternative fixed income investments and also a little bit talk about Giraffe. In a nutshell, if I have a little bit talk about Giraffe, Giraffe is an online fintech platform that curates alternative fixed income opportunities and brings it to the platform for individual investors. We'll talk a little bit more about for everybody's benefit. We'll try to give a good amount of information in terms of process that we bring to the platform. What kind of investment portfolios do we have, and are they good enough for today's volatile markets? And do they give us good non-volatile returns that we would expect from an investment portfolio? Then we'll kind of a little bit shift towards why Giraffe exists and how Giraffe can possibly provide you options as you look at building your portfolio for today's world. And then we'll also talk about the kind of opportunities that we bring on our platform in terms of product asset classes. And then we'll speak about how do we go about in curating opportunities, each and every opportunities in terms of evaluation of those opportunities, and how do we source it and bring it to our platform. And we'll also talk about what kind of journey we have been having. So we'll spend some time in terms of Q&A at the end. But please feel to ask me questions as we are going through the conversation, through the presentation. So if you have any questions tied to the topic we are discussing, feel free to ask, and we'll try to address it as and when. But if there are any questions that we need to cover at the end, we'll also have some time to talk about that. Before we go any further, I'll introduce myself. I'm JP or Jayaprakash. I manage growth efforts at Jiraaf. I have over 18 years of experience, primarily in the financial services space, between both domestic and global markets in the retail banking, wealth management, asset management, lending world. I have a background between engineering and business. And with me, I have the privilege to introduce Saurav as well. Saurav, you can introduce yourself.
Thank you, JP. First of all, thank you to everyone for joining in for this session. To introduce myself, we are two co-founders at Jiraaf, Vineet Agarwal and myself. My quick background, I'm a computer science engineer from Bitspilani, Goa, did my MBA from Ahmedabad. Post that for 10 years, I was in the corporate finance space. Started my career with the infrastructure sector and then moved on to real estate. For the 10 years that I worked in the corporate field, I was essentially raising capital for the company that I worked for. So did a large amount of transactions in debt, in structured credit, raising capital from international funds, domestic funds, private sector banks, public sector banks, and the like. So, that has been my background prior to starting off with Jiraaf.
Hey, thanks, Saurabh. I think before we kind of jump, I'll just have a quick introduction about the Giraffe team as well. The team, as the thing Saurabh was talking about, was a co-founder as well from Giraffe. Yes, a lot of it is in the BFSI sectors, and we have brought together folks who got experience in wide, I would say, functional expertise, and I've got good amount of experience in the domestic market, international markets, different industries, different areas, from products to engineering strategies. So I think we'll definitely speak about it, of how we are looking to build Giraffe to support and help the individual investors in terms of the investment portfolios. But I'm not going to spend a lot of detail on each and everybody, but want to bring it up that the team is, the company is backed by a very strong team. And in terms of investors as well, we are backed by one of the leading VC funds with Axel Partners, and supported by a good amount of individual investors, entrepreneurs, and family offices towards our growth efforts. And from there, I'll try to at least talk about it. I think the first question always have in my mind is uh, in this kind of if we can talk good enough, and is there something people missing, and how has been the journey from an Indian market standpoint?
JP, there's been a lag for me. I'm not sure.
Apologies for a short. There was a small internet disconnect that happened. So, Saurav, you can hear me, right?
I can hear you. Yeah, there was a lag. Yes. So, I think JP just set the context. So I think, what would be important to understand is, the journey of India as a country and financial markets here domestically, and how that has been evolving with time. I think, one of the key things is if you see equity markets opened up in the early 1990s, then mutual funds came in as a new investment avenue in early 2000s. If you see the journey of mutual funds, the early investors and early adopters of mutual funds were people who had exposure to equity markets in the 1990s. And it was a very small market in the early 2000s. But if you see 20 years down the line, a person is comfortable doing even 20-25% of their salary on a monthly basis, through SIPs. So I think what is important to understand, appreciate is all financial products go through a phase and journey where they begin being exotic or new, and then over a period of understanding maturity, both from a product as well as a market standpoint, they become mainstream over a period of time. And the kind of products that Jiraaf is trying to bring to individual investors out there will see a similar trajectory in the next couple of decades. uh, Important again to understand the need for always financial products that are evolving, because again, as economies evolve, as global markets evolve, there's a lot of uncertainties, variance that comes into with respect to financial investments. And as Giraffe, we are always and constantly in the lookout for products which are better for individual investor participation, and it should help each individual investor create a better financial portfolio. If you just take an example of today's market, we are in the middle of a very, very highly volatile macroeconomic environment. Inflation is at historical levels, and in all mature economies, obviously Russia Ukraine war has led to uncertainties in demand supply chains, leading to inflation, etc. If you look at India domestically, obviously, with elections coming up, with obviously the entire world recovering, from a pandemic, there's been a lot of uncertainties. Growth in mature countries have, slowed down. There's been talks of, recession in the US. Obviously that will have again a major global impact. China going through and recovering through the COVID wave, right? So there have been a lot of, I would say, large macroeconomic events that has played out across large geographies, recently, and which is leading to a lot of uncertainties in the global markets. Now, when markets and the environment is so uncertain, how do you actually create a financial portfolio, which will help, which will solve for your, I would say, financial goals or milestones, right? And that's it's very important in such scenarios that you have access to different kind of financial products that actually cater to different needs, from your own financial goals, and helps you actually create a portfolio that works for you, individually, right? Because each one of us have I would say different financial situations, and everyone needs to build their own customized portfolios, right? And I think the you can look at the two graphs over here, like the Nifty 50 as well as the India inflation rate, and you can see the volatility in these markets in recent times, right? And this is exactly one of the things that we try to solve for with fixed income or alternate fixed income products, is basically create a portfolio, which is not as volatile as equity markets are, and how do you actually end up, earning returns which are just not market dependent, but have, different factors that impact the returns of the underlying product. So, I think one of the very basic things that we have learned in investing is, key is diversifying a portfolio to not have concentration risk. And it just not doesn't mean on the individual investments that you do, but it also means on the kind of products that you choose, right? So you can have all your investments in fixed deposits, all your investments in equity markets, all your investment in bond markets, but those are all concentrated. So the idea is, how do you create a well diversified portfolio accessing different kind of products which solve for different problems and needs.
Yeah, I think Saurav, thanks for that. I think then the bottom line, the question then translates to, I mean, there's always the question that comes to that has been asked on whether it's what this alternate fixed income investments would mean, and does it even help, and should that be in the portfolio itself, right? So, talking about where we are, so how do you see that in terms of alternate fixed income, and is it something people know? Why was it not known, and is it now being more visible across? And how you can add to the portfolio, and what is your views on that?
Right. So I'll just use the graph on the top right of the screen. So you can see on the y-axis there is yield or return, and on the x-axis there is risk. We've just mentioned different kinds of products and just graded them on a return to risk spectrum. Right, on the bottom left of that graph, you see there is fixed deposit, saving, bonds, real estate, gold. These are your very traditional investment products which are considered safe and obviously give lower yields. On the other end of the spectrum, you see angel investing, crypto art, which are these new age opportunities, but extremely exotic. And obviously, while it can be rewarding, but obviously it's extremely volatile. We have all seen how crypto played out in the recent times again. In between, somewhere there is public market equities, and which again, most of us understand that product. Where we identified an opportunity is between public market equities and your safe havens of fixed deposit, gold, bonds, real estate. There's a large gap which is in between this yield range of 18 to probably 15-16%, which is kind of unaddressed, where there is a need for higher yielding products. At the same time, they should be non-volatile, and this is the bucket that we are calling as alternative fixed income. And the reason we call this alternative fixed income, because traditionally fixed income is understood as fixed deposits, bonds, public provident fund, etc., which are also traditional fixed income products. But this space where you're able to earn higher yields, at the same time earn non-volatile returns or non-market linked returns, that is the space that we are calling as alternative fixed income products. Now the question is, JP, that you asked is, should they be in a part of your portfolio? Again, fundamentally, as Indians, we think of a portfolio in three buckets, right? And we solve for either for emergency. So we have an emergency fund. Then we have a liquid fund for all our, I would say, needs and spends in the short term, or where we have clarity or visibility. And then we invest for growth or wealth creation, right? And typically the way we have been investing is most of emergency and liquid funds is always in savings or fixed deposits, and all our growth capital, either people invest into real estate or in equity markets. Now what that essentially does is that the portfolio becomes very, very concentrated on either side. People with a lot of, let's say, with a large allocation to growth capital, maybe up to 80-90%, end up having 80 to 90% exposure to actually equity markets. Now what that means is that 80-90% of your portfolio is subject to, I would say, market dynamics, will be impacted by global macroeconomic environment, and hence will be very, very volatile, right? So what we are trying to essentially say is that there is a big space for these alternative fixed income products, where you can either diversify, add some allocation maybe from your liquid funds and some allocation from your growth capital, create a pool anywhere between 5 to 20%, which is as per global studies, where the amount of exposure you should have to these fixed income products. Create an allocation of 5 to 20% in these alternative fixed income products, which kind of ensures that your overall portfolio returns are not impacted, and at the same time these are not market linked returns, these are not subject to volatility of due to external environment, and so gives an overall stability to your portfolio, at the same time not compromising on the overall portfolio returns. So I think that's the key benefit that fixed income products give you. I'll just use one example. Fixed income products are great for milestone or goal based investments, and I'll take an example here. If let's say someone wants to buy a car in 2 years time, or want to invest in a house, or want to plan a vacation, typically what we end up doing is we keep this money aside, or create again a corpus where we are building in an FD or a savings bank to make this expenditure 2 years later. Why? Because equity markets, if you invest today, you're not sure whether you can get the capital with any positive return or with any kind of certainty 2 years down the line. Now, alternate fixed income is great over here because there is a high amount of predictability, there is a high amount of certainty that I will get my money back within this specified time frame of 2 years with good returns, which can be double digit, right? 10, 12, 14%. So if you're able to earn high returns at the same time have predictability and certainty of your money, it really helps in making goal-based investments. So alternate fixed income as an asset class is extremely powerful, and it gives diversity to your portfolio. It gives it leads to predictable and certainty of cash flows, and at that same time ensures that not a large amount of your portfolio is so volatile, which ends up giving you sleepless nights, right? So I think, just to summarize, those are like some great benefits, and that's one of the reasons we feel that is a very powerful asset class. And in the next decade or two, you'll really see this mature in the Indian environment as well. Globally, already there is a lot of asset allocation that happens to fixed income in general.
Yeah, I think Saurav on this, right? I think there was a question from Aman. I'll repeat that question, but I also have another question that will, and there are folks outside as well. A lot of times they club a lot of these asset classes as alternative investments, right? And they call it alternative investments, and they feel that it's too risky, it's something unknown. Absolutely, they kind of think about it. I think it's important. I feel that to differentiate within that alternative investment space, the class of debt products that you're talking, which is the fixed income classes, and then there are class of products which are not based, more like a startup investing. If we can also clarify, is there's a lot of questions who say, okay, when you go to debt, they immediately start comparing. Okay, bond is one thing they immediately bring, and they think. And the question comes into how is the question from Aman is also tied to it is how is the risk compared to a bond, and obviously bonds have different classes as well. So if we can also answer that question, that would be great.
Yeah. JP, I missed your third question. I think again there was a lot of lag, but I can take question 1 and question 2. The first question is.
Yeah, the first question, if you can start, maybe we'll ask second question. This is
Yeah.
about clubbing everything in the alternative investments,
Right.
and what the differentiate between fixed and what are the other classes which are not fixed, and how is the risk?
Yeah. So, for everyone over here, see, alternative is a very wide, I would say it's a wide definition of financial products. What we mean by alternative is something that is non-traditional. So equities, real estate, gold, fixed deposits, right? So public provident funds. So these have all been traditional avenues for people to invest their money. Anything that is new and upcoming or beyond these traditional avenues is what gets finally defined as alternate, right? And in alternate, like the question rightly asked, that angel investing in startup cryptocurrencies. Today people have gone into the exotic world of, I would say, investing in art, wines, whiskeys. All of these then become a very wide range of the alternate space. Within that alternate space, where Jiraaf is actually focused, is alternate fixed income. Fixed income actually is a very traditional asset class. Across the world, it is, fixed income market, debt markets, they are actually larger than equity markets, but in India, it's the other way around, where it's just a fraction. What we are trying to do with this alternate fixed income space is essentially, make fixed income or debt investing mainstream, which it isn't today, right? So over here, the risks are very, very different. What you, in alternate fixed income, what you essentially take is underlying credit risk. And what I mean is, you're actually under investing in a debt instrument with a company. So a company or a organization is actually borrowing money from individual investors or from the retail market, and is basically promising returns like any other debt or loan would. Right? Something that we understand is I am giving a loan to a company. The company will repay my loan with the interest. Right? That is essentially what this asset class is. You're investing in debt products with companies or organizations with a view that this company is worthy enough and credible enough that they will repay my capital with the promised interest. Now, as individual investors, how do you know that this company is, credible, or is, credit worthy, or will, I can take a view or risk with this company? That's where Jiraaf comes in and adds value, right? We as Jiraaf, we are like, JP had mentioned, we have a team of finance professionals. We all come with decades of experience in lending, investing in financial services. And we actually, as a day in, day out, our job is to identify good quality companies who may not be as well known as your Tatas and Reliances, but are very credit worthy because they have years of operational experience, years of, a history of delivering value for shareholders, and as well as, as a business. And we feel that, they are credit worthy, where we can actually lend to them with the confidence that they will be able to repay. Right? That entire, identifying these companies, structuring these transactions, and then filtering it out so that we only pick good quality companies. That is the entire role that Jiraaf plays. So you as an investor, the risk that you undertake is what we call credit risk. Basically, when you invest with a company XYZ, you're taking a call that whether this XYZ company can repay my capital with the promised return. Right? This is actually a very age-old product. Global markets have been doing it for a long time. In India, bond markets, debt markets, fixed income markets are very, very nascent. And we are trying to make it mainstream. I think in the going, the presentation forward, we have also spoken about why the markets have not taken off, in the last couple of years or many years in India, and what is Jiraaf doing different, trying to address this space. Right. So I hope I answered the question.
Yeah, I think there's one more question. I'll take it, and there are a lot of questions coming, and I appreciate the questions coming. And I'll also try to take a lot of questions at the end. I'll probably take one question on the think about risk, because we are talking about investments here. I think if we can a little bit talk about the risk involved in these investments. Are these investments risk? How risky are they? And if you can make a comparison to typical bonds,
Sure.
if we can answer that question, Saurav, that would be great.
Yeah. So the difference between bond markets and what we are offering is actually a very small one. The reason bond markets are the way they are is because bond markets offer rated papers, right? And so typically a company AAA rated, like a Reliance or Tata Group companies, you'll see like people who are in the bond markets will see Muthoot Finance, Shriram Transport. There are companies that access bond markets very frequently. A lot of public sector banks, NHAI bonds. These are, which are basically PSU bonds or government bonds. These are the large kind of names that I think, are very, very prevalent in the bond markets. Now, the difference is in these cases, these are rated papers. So typically, you'll see a rating AAA, AA, and that's what, and mostly a very well-known, I would say, counterparty, whether that is Tata, Reliance, or the government, which is giving individuals the comfort to participate in these products. What Jiraaf offers is not something very different. The only difference is that we work with companies not which are AAA, AA, right, rated, but a tier 2 of your Tatas and Reliances, right? So these will be companies with good balance sheets. These will be companies with strong operating cash flows. We identify these companies and we feel they are credit worthy, and we bring these opportunities where you are obviously able to invest, in a debt transaction with them, but earn higher returns. If you give your money to Tata, Reliance, and government-backed bonds, you will be making 6, 7, 8%. But by giving by investing in a debt product with these mid-market companies, you are able to earn maybe double-digit returns. So obviously, you are investing in a company which is not maybe as well known, but you are able to basically earn that higher return for doing that. So we feel that this entire space is very, very attractive from a risk-reward spectrum, and that was the second question, because these companies actually are very, very credit-worthy. As Jiraaf, if you see, we will do very short-term opportunities. So everything that we do is less than 3 years. 95% of the opportunities that we bring to the table is actually less than 2 years. average maturity of the product that we offer is between 9 months to a year. So we focus a lot on short-term opportunities where we feel fixed incomes becomes very attractive, and we take a call that these companies which have been operating now for many years, can we take a risk of investing in a debt product with them with a 1 year, 18-month or a 2 year view, right? And that entire analysis, diligence and underwriting is done by Giraffe. So a lot of the product that we do, you will see they will not be rated, they will be unrated. A lot of them are rated, but there is a lot of track record and history that these companies have. These instruments and investments also come with very strong security packages. What I mean is, typically these investments will have strong underlying cash flows, very strong collaterals. A lot of time it comes with personal guarantees, promoter guarantees, corporate guarantees. We also have a charge or on a lot of their assets. So the security package is very good. We have a lot of visibility on the cash flows, and these are structured very well to mitigate risk. So overall, if we are, obviously you're taking a higher risk than a AAA rated company or from your fixed deposits, and that is why you're earning higher returns. But as Giraffe, we feel that the risk versus reward is very, very favorable in these companies, and that is why we bring them as an opportunity for you, right? So it helps you earn higher returns, obviously by taking incremental risk, but the risk reward kind of plays out very fairly, and that is why we feel that this is an attractive asset class, to be a part of someone's portfolio.
Yeah, I think, I mean, a lot of the questions, some of your questions will also be answered once we kind of continue and talk a little about Giraffe. I think some of it we already touched on, of for why we exist. So in terms of why Giraffe exists, I think Saurav talked about it. Tied to it, but Saurav, we can a little bit go through it. I think a lot of the points you already have covered in terms of why Giraffe came into existence. But we can spend a few minutes as we go through this story. So if you want to continue on this one, would be great.
Yeah, no, thanks, JP. I'll just quickly summarize this slide in a minute. Globally, as I mentioned, fixed income debt markets are very, very large. They are larger, in fact, than equity markets. But in India, participation in fixed income is very nascent. It is not taken off. It's a very small fraction, in fact, of equity markets. So, the need for Giraffe, what we have categorized is essentially why fixed income hasn't done well in India. And one of the key reasons is that, the summary of all the points is that products in the bond markets or in fixed income markets in India are actually not designed for individual investor participation. They are actually designed for institutions to participate. So typically you will see that the products are 8-10 years in tenor, 6-7-8% in yields. So from an individual, if I invest my own money, I won't invest in this, because for me the liquidity premium, or if I'm getting fixed deposit for 1 year at 5-6%, 7%, if you give me a 1-2% delta and say that invest in an 8-10% product, the lock-in is not actually just, and the yield is not getting justified by the lock-in, right, or the liquidity premium. Yep. So essentially the products don't get designed for individual investor participation. There are a lot of products where HNIs invest in, and they invest in through credit funds. They get a lot of structured or customized opportunities from their wealth teams. But these opportunities are just limited to the HNI segment, and there is no one actually curating or manufacturing products for individual investors, to invest smaller check sizes. Right, and then obviously there is an access. There's an entire thing of documentation, processes. How do you monitor investment? Post actually monitor your transaction post investments, and that is an entire area where there's a lot of, I would say, lack of transparency. And these are all aspects that Giraffe is trying to solve for. So we bring better products. As I mentioned, our products are between 6 to 18, 19, 20%. All are short tenor, so they are curated with an individual investor lens and curated for the specific purpose that individual investors are going to be participating in these transactions. Second is these are manufactured exclusively by us, and these are at the level of products or better than products which even HNIs have access to, and we are actually opening it up for I would say wider retail participation. As Jiraaf, we also try to ensure that we cater to all fixed income needs that you have. So we offer products between 6% to 20%, at the same time offer tenors between 30 days and 3 years. So you as an investor, you can actually curate your own fixed income portfolio. So we do corporate debt, we do inward discounting, and we'll talk about these products in the future. But you can basically create a well diversified fixed income portfolio because the entire gamut is available on the platform. And obviously all of this is brought by a very credible team at the back end. We understand debt investments very well. We've been doing it for decades, Jiraaf, and that's where the entire, I would say, experience comes in. And especially in financial services and especially in debt investments, that is a big plus, I think, which is what the team brings and to the table.
Yeah, thanks, Saurav. I think so from this one, I think we kind of talked about it. So some of the products that we offer on our platform goes, you talked about the fact that the yields are going all the way from 6%. Obviously, the rates comes in with very tenures, whether it's 30 days tenures to a 36-month tenure. Across different asset kind of products, fixed income products we talk about, whether it's a corporate debt with different, whether it's rated or unrated both ways, invoice discounting, leasing, venture debt. So if we can talk a little bit about each of these products and how that kind of also if we also touch upon how those assets actually help in the addition to their investment portfolio, and then we have a lot of questions, so that will give a lot of answers on the questions I'm seeing. So maybe quickly, Saurav, let's
Right.
do a brief on these products and we can
Yeah,
go.
yeah. So, all these fixed income products falls into, I would say, three buckets, and it can solve for three different kinds of needs, right? So one is predictability of cash flows, second is liquidity, and third is wealth creation, right? I think all the fixed income products that we offer on the platform can address one or all of the needs. So typically, if you look at corporate debt, these are, between 12 months to 36 months. They will have very periodic payouts, which is monthly or quarterly. So there is a lot of predictability of cash flows and certainty of it. You actually invest in these products and get some sort of secondary income for yourself, right? So it adds to a lot of predictability. Corporate debt is a product where you're actually investing with, very, I would say, good companies with a lot of track record in operations, in delivering value, with strong business models. And you're basically then expecting that this company will use this capital for growth, and hence will be able to repay you within the specific time frame with with the promised returns. Typically in corporate debt, there is a lot of security that goes along with it. So there will be cash flow trapping, there will be strong security package like personal guarantees, promoters guarantees, and essentially you're taking a call that the balance sheet or the financial strength of this company is good, and hence is able to borrow this amount. Inverse discounting coming here is typical. It's a very short-term product, so typically 30, 90 days. So this is a product which is great from a liquidity standpoint, right? So a lot of your liquid funds, which is earning, I would say, very low yields. Actually, this while you're taking a high risk, but you can substitute your, part of your liquid fund investments in a high risk product, which is inverse discounting, and which gives you 10 to 14% return, which is almost, I would say, double of any opportunity cost in this tenor range that you will see. It's again a great product where you are actually helping companies manage their working capital. Each company needs short-term debt solutions to manage their working capital because they typically provide services on day zero, but they get paid from larger companies after 60, 90 days, which is the standard, I would say, credit period that they get in their business arrangements. So typically there is a gap that these companies need in this time period where they have actually spent money in providing the services to when actually they will get their money back from the counterparties that they have given the services or products to. And then this gap is getting then financed by Jiraaf, and you are able to earn this 10-14% kind of return in a very short time frame. Leasing again is a great product because you earn 14-18% yield, but the great thing is that there is the kind of security that you have is great because in leasing you actually own the asset, and in our structures, we own the asset in a company. So effectively, if there is, let's say, a default and a company is unable to pay, you can release the asset to someone else. You can liquidate the asset in the secondary market and realize value. We ensure that the repayments are such that the debt is actually reducing faster than the depreciating value of the asset. So at any time you are sitting on better, I would say, cover in terms of the asset value versus the debt outstanding. So typically, one of the things, if you see, CapSave is a NBFC, people who know, they have built a 4,000 crore book in leasing and have not seen a single default in 7 years. So that's the power of this asset class. And we felt that again, it's very attractive to earn 14-18% return while you are actually owning the asset, and where you get a lot of comfort from a security perspective. Venture debt is one of those products which is helping you solve your wealth creation problems, right? So you can actually earn better than equity returns. I would say it almost gives you 15-20%. But here we work with startups which are typically, maybe a Series A, Series B funded startups. We are very selective of the kind of transactions that we do in venture debt, because obviously it's we need a lot of certainty and comfort that these companies will eventually grow and do well, at least in the next 2-3 years. And so we have been very selective about the kind of transactions, but when we get good quality opportunities, they are actually great investments from a wealth creation perspective. So like I said, all these four products, they can help you solve, predictability, which is also can be a source of secondary income. Leasing and corporate debt is great for that. Inverse discounting is great, to solve for your liquidity, problems or solutions. And then products like, some structured corporate debt or venture debt, or maybe the higher end of leasing, actually gives you these greater than 15% returns, which actually can be better than equity markets in some sense and help you in your wealth creation journey. So that's how I would look at it.
Yeah, I think so. You already talked about the securities on some of the underlying asset classes, with this corporate debt or asset leasing. You have underlying asset that you are actually giving the loans against, and security on the corporate debt in terms of receivables. So there's a question from Lohit tied to risk involved in the invoice discounting specifically. So what are the risks people should be aware of, and what kind of security or what kind of precautions will you take with invoice discounting investments?
Sure. So inverse discounting as a product, like I mentioned, is where, a company is providing services. Let's say a company A has given services or products or goods to company B and is expecting some payments in 60-90 days. So typically what we do is, because the company A needs money today, we give that, let's say 100 rupees to company A with the expectation that company B will repay in 60-90 days as per the underlying invoice that is raised. Right. So this is the entire structure. It's basically, you are taking a comfort that the underlying cash flows from the invoice which company B is supposed to pay will come in as per the current timelines. Right. So this is where the comfort is. Typically, they don't come with any hard collateral or security packages, because you have discounted a particular invoice. So you have the, so you're taking a call on the cash flow that is going to come from company B, and essentially that is what you're evaluating. So then the kind of things that become very critical here is obviously, what happens when this invoice does not get paid. So you need to evaluate two things. One is, what is the certainty of this invoice getting paid? That we do from, we do a lot of credit checks, but, few of the things is track record. What is the history of these invoices getting paid? In what timelines do they get paid? How important is company A as a service provider to company B? What is the reputation of company B? Are the invoices genuine? Are the services actually have been delivered? So these are kind of the checks and balances. We have to see whether company B will repay on time. The point B out of this is, let's say the money does not come in, then we actually expect company A to repay on 60-90 days, because they have utilized the funds in the first place. So then we get into the credit worthiness of company A, how strong are they, what is their financial strength, etc. Right. So it's a combination of who the service provider is, from where the money is going to come, and the entire control and process on cash flows. That is completely what is being, I would say, done by Jiraaf at our end. As an individual investor, some of the key things that you need to see is how transparent is the platform, especially in inverse discounting, because there can be a lot of mis-selling that happens in this space. So what is important to know is exactly on which counterparty are you taking the call. If you're taking the call on the underlying invoice, which is, let's say, raised to company B, then is the company B aware that this invoice is discounted? Is company B going to pay to a bank account which is controlled by the platform or for the investors? And what is the track record here? So if not, and then it is only a call that you're taking on company A because you're dependent on them to repay your money, then you kind of take a call on the financial strength of company A, etc. Right. So it's very important to understand, what is exactly the transaction here, on who are you taking the call, and what is the underlying structure. And if the platform, and as Jiraaf, we will always tell you who the vendor is, who the anchor is, and basically when you see a listed opportunity and it can be XYZ company, the name on whose company we kind of list the product is the name on whom you're taking a credit risk in this case. And we are very transparent about it from day zero. So even if our invoice is to HUL, but the company is, for example, let's say a Let's Transport or Calpro, essentially you should know that the credit risk is from Calpro or Let's Transport, right? So it's very important to understand that on whom you're taking a credit risk. And at Jiraaf, we have tried to be transparent about it from day zero.
Yeah, I think so. A lot of questions are coming on the list. So let's cover the next slide, and then I'll come back on a lot of the other questions that have been asked.
Yeah.
I think sort of we talked about this very early that it's not like Giraffe is bringing an opportunity because the borrower needs money, and we immediately bring that opportunity and list it on the platform to all our individual investors. I know we Giraffe undertake a very strenuous credit approval process in terms of looking at each and every opportunity and feeling fully convinced this is the right opportunity for investors. We'll speak a little briefly on this process, and then I'll take a lot of questions tied to the risk questions that have come to how we look at opportunities.
Yeah. So, this is a credit approval process in a lot of detail that's put on this slide. Again, I'll just summarize this, just to give some numbers today. As Jiraaf, we work with almost 35 counterparties. To actually work with 35, counterparties, we have explored more than or had conversations with more than 300 of them. So we end up actually speaking, interacting, with 300 plus companies to actually end up transacting with 35. So, that's the kind of filtration process that we have, and that, it's very, very rigorous. As already put out on this slide, it's a very detailed process. It almost takes us, 2.5 months to actually onboard a new counterparty on our platform to actually start transacting with. Right. So this process, you can think of it as in 3 stages. We have a very highly experienced investment team which originates these transactions. They do the first level of credit assessment at their end, because finally they know that what will actually pass the internal process, diligence, and the investment committee eventually. So they do a lot of filtration at their end. It finally comes down, to an initial committee where we take a call that should we spend more time on this proposal and get into a very detailed credit review and a due diligence. And once we take that call, the transaction actually goes to our internal credit and risk team, where they spend a lot of time on the due diligence part of it, which can vary between 30 to 45 days. This involves a big process. It goes into the, I'd again break it down into basically governance and conduct standards of these companies, which involves a lot of market feedback, data from a lot of various partners of what is publicly available out there. When obviously there's an entire aspect of business understanding that we get into as to, what exactly is the business model, how their financial strength is, how their balance sheet strength is, etc. And then third, we finally obviously need to take a call is this company, will they be able to actually repay the debt? And what exactly will be the source of capital? Is it going to be from standard business operations, and how can that be structured better? Right. So that's an entire part of, I would say, a very detailed analysis on financials, and then different parts of it can get into diligences by external third parties. So when we do like for example, when we do some real estate transaction, there will be a detailed, title diligence, approvals, etc. that we get into. So at the right stage, if required, we also get third parties in the diligence process, that we do. Finally, the call is taken by an investment committee. This investment committee has 6, people that actually sit on it. We also have 2 external advisors who we bring in at a time when when the need be, if the transaction is large or complicated. And this investment committee finally decides whether the transaction, post a credit analysis and a due diligence, is this good enough to get listed on the platform. And that final investment committee finally then takes that call, and plays that role of, I would say, a fiduciary responsibility, where we are trying to ensure that only very high quality and good credit proposals finally get listed on the platform. So it's a very involved, detailed, rigorous exercise. Post investment, we keep monitoring the transactions on a monthly or quarterly basis. We keep, looking at, we look at covenants, early warning triggers, we take a call on, can we increase exposure or should we reduce exposure with these counterparties. So it's a very involved exercise, even on a monthly basis, post investment, that the team is doing. And yes, and finally the output is, you can see today, I think, within the 35 companies, we would have repaid almost 400 crore of capital till date, not maybe across 250, 300 payment milestones, and not seen a single day delay. Right. So while that has been the and this is our journey so far. So till date, as of December, we had done 870 crore of disbursement through the platform. As we speak, we have actually crossed the 1,000 crore mark today. You can see we've done more than 320 deals or opportunities on the platform as on December end. Right, and a large number of users have shown their faith, and we are very proud and happy for that. And I think we've been able to repay their faith by demonstrating this 370 crore of repayments done till December, and not seen a single delay on the platform yet. Right.
Yes,
But
sir.
having said that, I think I want to repeat that none of these investments are devoid of risk. There can be delays in the future. There can be defaults. So I would request everyone to understand what product that they are getting into. They can spend half an hour call or a 1 hour call with our relationship managers and our customer success team, and they would be happy to explain the product in better detail or greater detail to the to everyone out here. And then you should make an informed choice. The minimum investment on the platform is 1 lakh rupees, so you can start small, give the platform a try for a few months, and then slowly and steadily start building exposure as and when you get confidence. So it's extremely important to understand what you're getting into, slowly, steadily build confidence yourselves, and take the right decisions and calls, eventually. As Jiraaf, we're always there to handhold you and support you, and would be very happy to, spend some time on a one-on-one basis with anyone who's interested.
Hey, thanks, Saurav. I think we'll start taking questions, Saurav. So a lot of questions have come towards. So CA Niraj, your questions was how many defaults till now Giraffe faced. So we spoke to you about it that I think we have been so far careful and we have not experienced any defaults. But as Saurav said, these investments carry risk. So there's nothing guaranteed the fact defaults will never happen. But so far, there's no defaults have happened. Nadi, same question you have in the past experience where have been default incidents, which I answered. And how do you handle such situation? And there was another question with Aka with Kunal as well. Whether when a default happens, what happens, and do we get principal or part of the principal back through the liquidation process? I think Saurav, we talked about the fact the process of evaluation, but can you tell briefly
Yeah.
that what do we do now if
Yes.
something happens like that?
Yeah, so I think to address defaults, I'll break this down into things that we do before a default happens, and then things that we can do after the default happens. Because a lot of the effort actually goes in minimizing the event of default itself. And obviously, once a default happens, there are some steps that we can do. So before so the entire process of structuring actually involves how do we ensure that the repayment of our debt does not add to the stress for the company, and they are able to repay the debt through their regular business operations. So what we also, if you see that any investment which is more than 6 months in tenure, typically will have monthly or quarterly repayments. So what that means is that your exposure to any investment, even which is 12 to 18 months in tenure, your exposure to the counterparty or in the investment actually is reducing with time. So if you invest in an 18-month transaction, you'll see post 9 months, you're actually got, maybe 60% of your capital already back. So in the last 9 months, you have maybe a 40% exposure left with this counterparty. So a lot of this is to ensure that, the underlying business cash flows of these companies are able to repay the debt without, adding to stress. I think that is very, very key for us. The second is, like I mentioned, post investment, we actually do a monthly health check of the companies that we work with. So we are very, at the time of doing the transaction, we know that these are the 2 or 3 key business risks that this company has. And we have some parameters to actually track those business risks, which we keep tracking on a monthly basis. The idea of that is if we see that there is, the health of the company is going down, or there is some red flag for us, we are able to exit that exposure early, and or reduce exposure going forward, and are proactive rather than reactive. Right. So these are some things that we do prior to the default happening. Post default, obviously, there are 2 things. There is, in cases where there is a strong collateral and security package, we will move towards, before going there, a default is not equal to a delay, right? So in a lot of cases, a default might happen on a payment due date, but we will be able to actively talk to the company, converse with the company, find the solution, and maybe you get your capital back or part of your capital back through from the company directly itself, maybe with some delay, right? But let's say that that is not happening and there is a proper default, then we actually move to enforcement, which is you have legal recourse. Legal recourse will be through contracts and through documents, and also you can drag the company to bankruptcy because you have given them a deadline. So there are IBC courts which have become very, very efficient today. So you go to a company through bankruptcy as a financial creditor or as a person who have given debt, you will be in one of the first people to get your money back from whatever proceeds that come through the liquidation process. Also, you have collateral. So in cases where you have personal guarantees, corporate guarantees, we'll move towards enforcement of these guarantees. And where there are hard collaterals, we'll try to monetize or liquidate these collaterals and get our money back. Like I mentioned, leasing is a great example where you actually own the asset. So if a default happens in a leasing transaction, you have a lot of different recourses, like you can release the asset or you can actually sell it in the secondary market, recover value and repay it, right? So these are all avenues available to you once the default happens. But once it goes into a default and you're going into an enforcement proceeding, there is no certainty of the outcome. You don't know whether you'll get 100% capital back, a partial of it, or nothing at all, right? So in debt and in lending, the entire, I would say, focus is to avoid the default, and that is why we spend so much time and rigor on the due diligence on actually selecting the right counterparties to work with. And if you invest in 100 transactions, market benchmark is you can assume that the default rates will be 1% or lower. So if you participate in 100 opportunities, maybe one of them will default. And so if you are well diversified enough, you at your end, the impact at a portfolio level will be minimal. So my recommendation here is to diversify as much as possible. The reason the minimum investment size is 1 lakh is so that you can participate across 6, 7, 10 opportunities, putting 1 lakh each, so that you are well diversified. And if any untoward default happens, the impact at a portfolio level is minimized for you.
Thanks. So I think a lot of questions are Kiran, Shalil, Kishore. I think hopefully it helps you understand how we look at defaults. If defaults happens, the process that we take to kind of look into it, and also the credit risk and post investment, what our process. And there's a question about whether Jiraaf guarantees for return in case of default. I think we already talked about it. All investments carry risk, whether you're talking on bonds or stocks. Similarly, all the investment products that we talked about today also carry risk. As you probably, we also covered the fact that how we try to minimize the risk by undertaking a very strenuous process, both pre and post investment, to make sure we keep it to make sure monitor and be able to give it without default. But all investments do carry risk. And there's a question about even well-established companies not able to give 14% return. How do we believe that this gives 15%? It smells significantly more risk and too good to be true. That's a question from Vinod Kumar.
Right. So, typically banks have, sorry, not banks, companies have 2, 3 avenues to actually borrow capital. So they can be banks, they can be, traditional lenders, but non-banks like other NBFCs. And third can be capital markets or, I would say new age platforms like Jiraaf, where we are giving them some access to capital markets. So typically banks, when they borrow from banks, they obviously give a very lower, it'll give a lower rate of return, when it comes to banks, but it typically comes associated with, keeping 100% of your money in FDs. There will be strong collaterals where, you'll have to mortgage your house, etc. And that's how banks typically structured, because they go by template funding, which is basically a very standard security package. They don't get into understanding your businesses, etc. What we try to work with when we work with what we try to do when we work with companies is actually understand the business model and give them a solution that actually works and helps their business for growth or for working capital. And so typically these companies, from a equity return perspective, they will be making 20-25% or more return on equity, depending on the kind of business or company they are in. And they are very happy to let's say bear a 12 to 14% kind of cost of debt. I'll take a very simple example. Let's say most people understand trading very well, right? So a lot of companies, when they do trading, which is just buy and sell, they are making 4 or 5% margin over 60 days. So which is 2.5% over 60 days. When we give them a working capital solution, our cost of debt is say 12 to 14%. They're effectively getting the debt at 1.1 or 1.2% on a monthly basis when they're actually making a 2.5% margin. So they have a delta of almost 1.4 or 1.5% at a margin basis on capital, which is actually debt funded and not their equity, right? So there is a lot of leeway for them to borrow and borrow at a 10 to 14% kind of cost. And good, most AAA, AA rated borrowers borrow between 7, 8, 9%, right? But if you're a strong mid-market company who don't have access to, let's say, such kind of bank lines, or you don't have access to, I would say capital markets because you are not AAA rated or AA rated, then you actually end up borrowing capital at 10, 12, 14%. Even we did a transaction with Jindal, which is a listed company, which is 18, almost I think 20, 30,000 crore market cap company. That transaction was at 12, 13%, right? So even companies as large as Jindal, which is publicly listed, 30,000 crore market cap, backed by very strong promoters, also borrow at these costs, right? So it just depends on the nature of the transaction, what problem of the company that you're solving, and whether for that problem and the solution that you're offering, whether 10 to 14%, 15% kind of makes sense for them. And most companies, I would say, for these kind of solutions, they are willing to pay this cost of debt, and it's very market standard. It in fact not even out of the market. So.
Yeah, I think there are a lot of questions. Yeah, there is a question on the few questions try to. Can you please share the regulatory structure on the alternative investment? Maybe we can talk a little bit high level on that.
Right. Yeah. So, what everyone needs to understand is all products that we offer, which are debt in nature, they are backed by regulated instruments. Right? So, in most cases, like in corporate debt, venture debt, leasing, we use an instrument which is non-convertible debentures, NCDs. These debentures, you can think of them like bonds. They are in dematerialized form. So they will, when you invest, you will actually see this instrument in your demat account. There are very clear SEBI regulations on public placement or private placement, and so we follow those regulations to the T when we actually curate these products or structure these transactions. So as a debt holder, the way you can think of it is there is a company that is issuing these debentures, and you as an individual are subscribing to them or investing in them, right? So like a equity share that shows in your demat account, you will see this debenture certificate in your demat account, which is essentially that the company has borrowed money from you and is liable to repay you the money as per the value of the debenture or the face value of the debenture that you own, right? So so that's how it works. There are very clear SAC guidelines by SEBI, by I would say Companies Act on these debentures and the processes with them, which we follow. The second is like when you participated in invoice discounting. Inward discounting is governed, again, it's an instrument which is recognized by the RBI. There are relevant regulations for inward discounting, which is the Factoring Act, etc. And when you invest in these transactions, you are actually, it is through a third party contract where you are purchasing receivables, which the company has as an asset on their books, right? So again, we all, as Jiraaf, we work in fact with the best of law firms. We work with Ernst & Young, Amar Chand, as a legal advisor. So a lot of these transactions are structured with the best of minds, and we follow all the relevant regulations that are out there in the market, respectively, for the instruments that we offer.
Yeah. Thanks, Saurav. I think there are a few questions I'll quickly. I think one of the things is tied to whether all products will come into the demat account. Aman, so there are certain products like corporate debt, NCDs, commercial paper. Some instruments will come into your demat account, invoice will not. So it depends. And if you have questions, please connect with us. We'll be able to happy to answer those questions. And there were questions related to risk rating. I think as we probably talked about the policy we are going through in terms of evaluating the investment opportunities. Yeah, each of these investments we internally evaluate different risk criteria, and based on that we choose. And we do take into account all the, as Saurav mentioned about the cash flows, the cash back, the strength of the company, the growth, the financial metrics, financial statements. So all of this will be taken into account, and through some internal risk ratings, we do evaluate every regional opportunity. And if recession is coming, I think that's the question we get from you. With recession looming, is there any changes? we will definitely take into account all those as factors as we're looking at this company. There's a very good question that Abhijit asked, which is relevant, which I do get a lot, right? Why do people need to come to you guys? I have banks and NBFCs who can give me money. Like, why are these companies coming to you?
Yeah, yeah. So, companies, I would say, come to Jira for, raise capital for various reasons, right? So, as I mentioned, diversity is one thing. Even diversity of lenders is a very key thing that companies look at. So, for example, companies that are used to taking money from banks also want to take from NBFCs, also want to take from retail investors as a source of capital, because every source actually goes through its own cycles. For example, last few years, like not the last 6 8 months, but prior to that few years, the companies, all the banks in India were going through a credit squeeze cycle, right? Like because of large NPAs, they were not actually lending. So banks had stopped lending to a large extent, even in the last 5 years post the ILFS 2018 crisis. Then currently today, if you see, most NBFCs in the corporate lending space are actually not active anymore. So NBFCs as a source of capital today has dried up, but obviously banks are stepping in and providing more capital today. And similarly, so what companies try to do is they try to borrow money from different sources. That so today, let's say 6 months, 1 year down the line, if the banks or the NBFCs are going through some credit squeeze where they are not lending, they know that there is one more avenue, which is the retail market, available to them to start raising capital from or borrow. And so that's one of the reasons, key reasons, why companies like to have diversified sources of borrowings on their balance sheet. So beyond banks and NBFCs, they come to us. Second is obviously flexibility and structuring. So most banks, while they obviously are lending, but they do template based lending because they actually can't get into understanding. They have 5 6 lakh crore AUM, working across every city in India. So they actually don't have the bandwidth to get into understanding businesses and structuring customized solutions. So as Jiraaf, what we are able to do is actually spend time in understanding business requirements and able to provide customized and structured debt solutions to them, which is extremely valuable. An easy example of this is, for example, let's say a company wants to set up a warehouse. The first 6 months the company sets up the warehouse, there might be no revenue that gets generated, but the warehouse might stabilize 6 months later. So as Jiraaf, what we are able to say is, hey, don't pay us interest for the first 6 months, but pay us when it starts generating revenue. Now, this is a flexibility that banks are not able to offer, right? And that's the reason they come to Jiraaf. And finally, there are large pockets of the ecosystem where there is a big credit gap in India, where bank and NBFCs don't operate. Jiraaf also finds these spaces and opportunities where there is a lot of good quality, I would say, companies out there, and we actually structure products for them. So so there is lesser competition in that sense, because banks and NBFCs, for example, they don't fund startups very well because they don't understand negative cash flows or a loss generating company, right? So that's one example of it. So these are the three reasons where we find value, and that's the reason they work with Jiraaf.
Yeah, thanks, Saurav. I think broadly, uh, yeah. So I think there is a question again on the rating. I think among your questions about one of the opportunities right now on rating of triple B. So we kind of talked about it. While there are some opportunities, you also see a short-term product that we have on the platform, which is a collaboration part of a title group of companies, which is a highly rated A1 paper on a short-term standpoint. And we do have opportunities, as Saurav mentioned earlier, that we'll have some mid-tier companies like we do have Onyx now with triple P. But when we evaluate, so we do have a range in terms of ratings of the companies between very high to triple B. So, but every
Maybe I
opportunity
will
that
take
we
this question one second on the rating, because like I think the question is, like, there's a triple B rating company, why is Jiraaf working with them? I think first it's important to understand that all ratings are long-term ratings. So when rating agencies give a company a triple A or a triple B, it is a long-term view of the company that they have. That means they try to see how sustainable is the business, their business model over the next 5 years, 10 years, etc. When we are curating products, we take a view of very short tenors, right? So, for example, Bhanex, which is, or Kashi, which is currently listed, while it is triple B, if you see the structure is, it's a 12-month transaction with monthly amortization. So every month during the 12 month, you get 1/12 of your EMI back. So what are we doing? We are taking a call that is this company triple B, it is very well equity funded, it's profitable, it is growing. can I take a 12-month view and debt call on this company? The answer is yes. We have also de-risked ourselves by ensuring that we get monthly cash flows at the end of every month. So you're actually getting de-risked from the opportunity to that extent at the end of every month. So at the end of 6 months, you almost have 55-60% of your capital paid out. So while the long term of the rating might be triple B, we are taking a 12-month on the company, further de-risked it with monthly amortization structure, and that is how we make a view and bring that product to Jiraaf. Now, and because of obviously being triple B, you're taking that increased risk, and that is also the reason you're earning a 15.5% return on this investment. So you need to look at risk compared to the reward that you get, and compared to obviously how we have structured the transaction and the security package for you.
I think I'll combine a lot of the questions, few other questions. One is about the sectors we operate in. So that's one. Second one is, do all deals have a rating? Second thing one. And why information that we are providing on the platform, why can't we give the full financial statements of each and every thing? I mean, I'll try to combine it because it's all about information. So I don't know, sorry, you want to take it? Yeah, that's fine.
Yeah. Sorry, I missed the first question in this.
So which is like the sectors we operate. Is it specific
Yeah.
sectors we operate?
Yeah.
Is it more diverse?
Yeah, so the sectors are, like JB mentioned, very diverse. We try to be as diverse as possible because we feel in every sector, in every bucket, there are there are a handful of good quality companies, and we want to work with those good quality companies in every bucket and sector. We don't want to go down the credit ladder, by being very sector focused. So in fact, we are quite agnostic, very wide, so that we are able to pick and choose, good quality companies in every sector and try and work with them. So in short, we are quite varied and not quite sector agnostic in that sense. Second is not, in fact, very few, we have rated as well as unrated transactions on the platform. Like some mentioned, like Bhanex is an example of a rated paper, which is triple B, but we also have a lot of unrated transactions. Currently, you'll see Carrot Lane, which is short-term A1 plus rated. So we have a good mix of rated as well as unrated papers, and that information is available to you. The third question was, why can't we make every financial available? Please do understand, these are private companies. They are not, most of them are not publicly listed companies. Because they are not publicly listed companies, information is not out there on a public platform. We actually sign non-disclosure agreements. We actually sign, agreements with companies because they don't want their information, out there for public consumption. So we provide information which we feel is relevant for you to make an investment decision, and we don't basically put the entire history and geography of that company on the platform. But if there is any questions, and if you feel the data is not enough to make that choice or that decision for yourself, please reach out to the team, and we will be happy to have that conversation and provide that data over a call, or take you through our analysis and understanding of the transaction, which will help you make that choice or decision.
So I think I'll be conscious of the time. Thanks for a lot of folks who be attending. I think I'll probably close with the last question about it. Is how does Jiraaf want? I think that's a good question, probably.
Yes. Yeah. So, we are all folks from financial services. So we need to have a revenue model. Otherwise, we don't understand the business ourselves. So yes, the way we earn is essentially we agree on a cost of capital with the companies. So for example, let's say a company is willing to pay 12%. So we say, hey, okay, great, you are willing to pay 12%. They pay us 1 or 2% as fee, for listing this transaction on the platform or for arranging it, and they'll pass on the balance 10 or 11% to consumers or investors who participate. So we earn our fees by charging to the companies as a one-time fee, and we pass on the rest of the yield or coupon through the platform to the investors who participate. We don't charge anything to the customers who participate on the platform, and you exactly get the yield that you see when a product gets listed.
Yeah, thanks, Saurav. I think I will probably definitely want to thank all the participants who have joined today, and we'll be 15 minutes over, and thanks for still sticking with us and listening to us. So that will end our Jiraaf Connect this episode, and as you probably would know, you'll be getting invites, and this is something we'll be doing it very often on specific different topics, whether it's on the risk side or different specific products. So we'll keep you updated and we'll send you invites. And please feel free to join other webinars that we probably have on different topics. So again, thanks for attending. Have a good day. Thanks, Saurav.
No, thank you. Thank you everyone for joining in and taking out time, and hope to see you in future webinars. My only request is for people who don't understand products or still have questions, do reach out to us and we'll try our best, to give you more, I would say, information and, hopefully clarify your queries. And if you still have some doubts, to try the products, try with the minimum size of 1 lakh, and you can, slowly and steadily see whether it's comfortable for you and whether you're actually getting a hang of this asset class. I request you to spend some time with the team and actually understand these products, and it will actually help you create a better portfolio for yourself. Yeah.
Thanks all.
Thank you.